coming hot off the heels of a week that had everything from earnings to central bank decisions to US-China trade talks reaching a conclusion. This coming week similarly sees plenty to sink our teeth into. Of course, the first week of the month generally brings a focus on jobs, and with the US shutdown in play, half of that jobs data is not going to be available. Nonetheless, we still have plenty going on when it comes to central bank decisions and economic data in the week starting Monday, the 3rd of November. So let's look at these big ticket items. Of course, you can see at the bottom, generally we would round off the week with the jobs report, but with the ongoing shutdown, it looks likely that that won't come out this week. So the caveat here is that some of the US data probably won't come out, but we still do have quite a lot going on. As you can see here, we kick off on Monday with the manufacturing PMI coming out of China. That comes off the back of the headline manufacturing PMI just dropping to 49.0. So declines in terms of the Chinese manufacturing sector. And this, of course, would be the private reading. So that is sort of more small to medium-sized businesses, whereas the headline reading is more focused on the bigger businesses. In terms of Monday, from a US perspective, though, the ISM manufacturing PMI is released, and that is going to be a real key release. That, alongside the ISM services PMI, are going to be two key releases coming out of the US in a week that, of course, sees quite a few other things essentially taken off the table, including the JOLTS job openings figure, which is on Tuesday. We have got the rate decision from the RBA overnight, Monday into Tuesday, depends where you are in the world, but yeah, that's one of two rate decisions. We've also got the Bank of England interest rate decision on Thursday. Now, neither central banks are expected to cut rates, but certainly there's an interesting story on both sides, certainly focusing around inflation, that should point towards significant interest going forward. Then we have more data coming out of China. We've got imports, exports, more trade data that comes out of Germany. This is on Friday, and then we wrap things up with a jobs report that might happen, might not happen. We'll have to see. Essentially, it comes down to whether the shutdown comes to an end or not. But we'll kick off with the US. As you can see, Friday could be busy, probably won't be busy, but we do have a focus on the jobs report thanks to the ADP payrolls figure that comes out on Wednesday. We've also got these ISM PMI readings. The ISM numbers I love because you also see the sort of breakouts in terms of the different sectors. This has highlighted the employment within manufacturing, but you get more than that. You get new orders, you get the likes of prices paid, and so it tells you everything that's happening and underlying within that sector in the US. Now, of course, the ADP payrolls release provides us a key insight in terms of the direction of travel for US jobs. And of course, coming off the back of a FOMC meeting that, yes, cut rates as expected, but also saw Jay Powell essentially say that December is not a foregone conclusion and that there's some indecision within the group over what to do in the next meeting. Now, that means that we're going to be data dependent, but we don't necessarily see data or much data because of the ongoing shutdown. Now, Powell alluded to the fact that he thought the shutdown would be finished before the December meeting, and therefore he expects to have data. Nonetheless, of course, in the absence of, for example, Friday's headline jobs report, it means people are going to be more focused on the data that we do have. And the ADP payrolls figure, over the years, people have criticized it and said that it doesn't give you a good idea of where the ultimate payrolls figures are going to come out. That may be the case, but in actual fact, what we've seen over the course of this year is that with the massive revisions lower in terms of the headline initial figure into the final figure, in actual fact, the ADP figure has been a closer indicator of where the final figure will come. Now, you can see here in terms of the sort of wide spread that you sometimes see at the bottom, the differential between the ADP figure and the payrolls figure. But nonetheless, like I said, in the absence of any other jobs data, the ADP payrolls number will play an important role. And you can see the last time around, we saw it in negative territory. In terms of this time, markets are expecting a rise back into positive territory, 15K. Maybe that happens. Maybe it just provides the basis for underperformance once again, considering the past two readings have been negative, or maybe it does come out positive and it gets revised lower. Like ultimately, it's a pretty weak number in any case, even if it does come in at 15K. The job creation numbers in the US certainly aren't particularly impressive at the moment, but arguably that's what we need to continue to see if we want to see that rate cut from the Federal Reserve. So we don't necessarily want to see a complete collapse in terms of the jobs market, but if we suddenly see particular strength out of the jobs market, then that December rate cut looks more unlikely as a result. Like I said, we've got the ISM PMIs coming out. There's a few charts I wanted to show you for that. First and foremost, this is the headline PMI numbers compared to the prices paid elements. Essentially, the PMI numbers have been propped up by inflation here. So arguably, you would say, oh, inflation's a bad thing, but it's put into the PMI number as a positive, essentially. So you could see very weak employment, very weak new orders, and really high inflation. And essentially, it sort of moderates the release, the headline figure in the end. So what you can see here is that by and large, services and manufacturing PMI sort of trundling around above when it comes to services, below when it comes to manufacturing, around that expansion mark. However, things are different when it comes to prices paid. We've seen very elevated prices, notably coming off a bit in terms of the manufacturing sector. So that's worth watching out for, because this should be a leading indicator of where prices are going to go down the line. We have seen inflation sort of pick up a bit, but not necessarily massively. Sort of 0.3s, 0.4s. Headline CPI is currently at 3%. So it's above where we need it to be, but we haven't necessarily seen a massive surge. So if we see that sort of initial surge in terms of the prices paid elements and then it rolls over heavily, then it does mean it's a sort of temporary move that the businesses are having to face in terms of the tariffs. Now, this is the breakdown in terms of the manufacturing PMI. And like I said, you've got by and large pretty much, well, two of the four in the form of employment and new orders are in negative territory. So they're sub 50. Production is only just above that 50 mark. And then prices paid massively above it, well into the 60s, previously up towards the 70 mark. And so it's a similar kind of picture here in terms of services, apart from the fact that we haven't actually seen that nosedive when it comes to the prices paid element. So this is sort of a stagflation kind of situation, really. So businesses not doing much, not hiring much, not growing much, but prices elevated. It's not necessarily a great picture. So in the absence of much of the data that the Federal Reserve would rely on, I think this is going to be an important one to watch out for. So what's the outlook for the Fed going forward? Now, we have seen a shift in terms of expectations for the December meeting. Previously, it was a case of essentially December being a foregone conclusion. It wasn't long ago that we were pointing towards December being above 95% chance of a rate cut. Market's now pricing it at 72% chance. That was 70 before that. So essentially, this in the wake of the FOMC meeting, people are really starting to question the validity of the December rate cut. Now, it's still the base case scenario, and heavily so. So it's not necessarily the case that after that meeting, suddenly people are saying, oh, it's not going to happen. People still do expect that rate cut, but really it's going to be data dependent. Like we said, we've still got a fair amount of data between now and then, but it really depends on whether the shutdown is going to come to an end or not. In the meanwhile, we're going to have to look out for the data that we do have. And of course, the ADP payrolls in particular will be really key to that, because it's been the jobs market that's been particularly weak. And then if you're looking at the ISM PMIs, then look out for the employment elements. As you can see here, employment within services, heavily in contraction territory. Employment within manufacturing, heavily within contraction territory. So both of them signaling a similar kind of story that we're seeing from the likes of the ADPs and the headline payrolls. And then beyond that, it's really a question of where the sort of neutral rate is. Markets are pricing the rate cuts to essentially end around the sort of 3% mark. Maybe that comes to fruition or not, but Certainly, when we're looking into context of this data, it's going to be a case of how does it impact market sentiment. And if we see weak jobs data in the week ahead, you would expect it to push things a little bit higher when it comes to the likes of the expectations around that December meeting. So let's just kick things off then with the chart perspective with a view towards gold, because I think this is a really interesting market. I mean, ultimately, it's one that I know everyone loves to trade. We've seen a significant pullback of late, and so it's a case of really trying to sort of find where that bottom is or try and gauge whether this is a top. So this is the sort of long-term trend. So of course, it's been an incredible market over the course of this year thus far, but the past couple of weeks we've seen very significant downside. Now, notably, that downside has taken us into the 38.2 Fibonacci level. You can see it here that we've tagged it absolutely perfectly. And we've seen a nice strong bullish engulfing candlestick formation. Now, what you could say here is that essentially we're just retracing this move from here, right? And that may be the case, right? And so the question mark, I guess, would be, do we see respect at Fibonacci resistance levels? You can see we sort of came up towards that 61.8 at the moment. We're sort of weakening a little bit as we close out the week. Do we see this... let's just go back here. Do we see this support level at 38.2 and essentially at 3900 as being the low for this market? Look, I would say the reason why we saw this market top out, or certainly the news that was hitting at the time that this market topped out, was around the potential breakthrough between US-China trade talks and allaying some of the fears associated with that. Now, we've now seen that deal. The deal has been made and we can move beyond that, right? So arguably, there isn't necessarily that piece of news yet to come. So I don't necessarily think that it's a case of, oh, well, you know, there's talk of a trade deal, but when it does come, that could really hurt gold even further because we've already seen it now. So what's the potential change that's going to happen down the line? Well, arguably, I would say US-China trade relations are always going to be a potential sticking point. I don't necessarily think that this suddenly means that everything's going to be hunky-dory between the US and China. They're still going to be acting against each other behind the scenes in one way or another, whether it's through BRICS on the Chinese situation or whether Donald Trump suddenly turns around and says, actually, they're not buying as much soybeans as they said they would. We're actually going to ramp up tariffs. And suddenly we see that story coming back into play. So I think it's more likely we see a turnaround into sort of negative news on that front than positive. So I think we've probably got all the positive news that we're going to get over the near term from that perspective. Aside from that, I think one of the main themes going into why gold has been so attractive is around the notion of debt in the US. $38 trillion worth of national debt now, and that is just going to go up and up and up. Anyone that has been in debt will know that the more in debt you are, the more or the faster it goes. So, you know, it's not going to turn around. They, of course, do have significant tariff income now that helps, but it doesn't help enough. I think they pretty much take in on a month what they pay out in interest payments on a day. And so, or what the amount that the debt pile goes up in a day. So that's not going to do enough, but it may slow it down a small amount. Of course, you have question marks around the US shutdown. So you could say when the US shutdown ends, then maybe we see gold being hit. I don't necessarily think that's going to happen, quite frankly. I think the length of this shutdown really is indicative of how dysfunctional things are over there. So I think that a lot of that negativity is out the way. Now, does that mean that everyone's now suddenly going to buy into gold? Well, we did see that strong bullish engulfing candlestick formation coming on the same time as we saw the US-China breakthrough. So that is interesting. And in actual fact, I can't remember what TV channel I was on. I was on a TV channel recently and they were asking me, when is the bottom? And I said, I wouldn't be surprised if the bottom is the US-China trade deal. That could be the case here, essentially, because that was the big question mark for markets, considering the sell-off that we saw in the first place. I mean, obviously, we could still very clearly be in a sort of short-term downtrend because of the fact that we haven't broken up through your 41.54. So I'm cautious on that front, but we have got this sort of little double bottom formation. I personally think that this is a market that is going to run for years to come. I think the debt situation is concerning. And looking further out, I mean, I don't want to get too philosophical with this, but I think the situation where we have people probably losing their jobs to AI, an idea that the central government is going to have to start dishing out money to people because people don't have jobs because of AI. So companies will make lots of money, individuals will have a higher unemployment rate, less people will pay in, more people will want benefits, and therefore the government is in the situation where it needs to spend more, right? So I don't necessarily think we're going to reverse course in terms of this direction of travel, in terms of the overspending of governments. And that just points towards that debt situation becoming more and more problematic over the years. So I see gold as a major hedge towards that. And so, yes, the question mark still is, do we see further downside over the near term? That still is, of course, a potential given the sheer size of that rally. And certainly a rise through 41.54 gives me more confidence that we're done with that. But personally, I think the big risk was that US-China trade deal announcement. But as we've seen, that often the point where that risk essentially is taken off the table becomes the point where markets start to buy. And we've seen gold enjoying that as a result. So I am bullish. I think there is a good chance that this is the end of the sell-off. But there's also a chance that we see another leg lower back towards sort of 3,700, 3,750, maybe around that next Fibonacci level. So a key thing would be, do we remain above the 39.15 mark? Now, if we're looking in terms of the context of the week ahead, which of course is what we're talking about right now, you would have to say if we see weakness in terms of the ADP, weakness in terms of the employment elements within the ISMs, that feeds into the narrative that we do see a rate cut from the Federal Reserve in December, and that should be positive news for the likes of gold. So keep an eye out for that in the week ahead. Next up, let's look at, here we go, the UK. Now, the UK, of course, has a focal point for the week ahead, and that comes in the form of the UK Bank of England rate decision. And now markets aren't expecting any change, as you can see here, 4% currently in place. But there's question marks because we are starting to see some people calling for a November rate cut, or at least a bringing forward of rate cuts. And the reason for that is that we saw a relatively weak inflation gauge last time around. We're about to see a budget that's going to ramp up taxes and put pressure on the UK economy. Certainly the UK economy does need help. Whether the Bank of England is going to provide that help remains to be seen. But certainly if you look at the videos that I've been preparing for you guys, highlighting the direction of travel over the last, say, 5 months for inflation compared to the year-on-year figure that everyone's looking at, there is grounds for the Bank of England to move a little bit earlier. I think it was JP Morgan that called for a rate cut in November. So here's the inflation breakdown, and you can see here the big problem here is April, right? And that April reading came from a number of things. In part, it was a fallout from the budget last time around. So there is concerns that this budget could do a similar kind of thing. Rachel Reeves has come out and essentially said, I can't remember whether she came out or whether it's just rumours, other people essentially saying what she's planning to do, but she wants to bring down household costs. She doesn't want to spark a fresh surge in inflation. The problem is she can say that, and she can maybe try to take the tax off of your energy payments or something like that, right? But it's quite difficult to enact taxes on people or businesses without necessarily raising their costs, quite frankly. So I think there's a good chance that she ultimately ends up hitting certain businesses and they just put their prices up. And therefore you end up getting inflation by that way anyway. So, there's still big question marks about where inflation is going to go after this budget. But as things stands over the past 5 months, UK inflation has been under control. As you see at the bottom, the 5-month annualized highlights the fact that UK CPI over the past 5 months is consistent with the pace needed to hit 2% once we see that April figure stripped out. So the Bank of England could see that and think, well, now's the time to move. However, they of course have uncertainty in the form of a budget, and that's why I think that they probably won't move this time around. But certainly, it's worthwhile looking into exactly what they're saying in terms of how they're taking in this data. This is the outlook in terms of the UK jobs market, a rise in terms of the claimant count last time, coming into the highest level of the year. Then we've also seen unemployment on the rise, still below 5% though, so it's not necessarily like super high or anything. In terms of UK rates, this is why I think it's a really interesting one to be following the likes of the pound, because the UK now stands, I think it's been updated since yesterday's FOMC cut. So where are we? Bank of England, green. No, I don't think it has. Okay, fine. Anyway, essentially the Bank of England is around the top of the pack when it comes to where rates are. And so we have seen some rate cuts, but they still have plenty of grounds for downside from that 4% mark to get towards the sort of 2s to 3s, which are likely to be the sort of end game for many of these central banks. So they've got plenty of room to move into, whereas certain central banks like the ECB, probably pretty much done by now. In terms of expectations, you can see there is a chance that we do see a rate cut this time around, 30% chance according to Refinitiv, but more likely in December, where there's essentially a 50-50, near enough. Yeah, a little bit more. So 53% chance we see a rate cut and then sort of growing in confidence as we move forward. But really, we need to see inflation under control. And that's why I do think, there's a pricing around near-term rate cuts. But if we do see inflation coming off, if we don't see a spike in terms of inflation from this budget, then I think the expectation for where rates go over the course of 2026 will shift significantly. But right now, there's indecision because of the data around the uncertainty around the inflation picture. Now, in terms of the likes of Euro sterling, this is one that I've been, let's just bring up cable actually, because cable's been a big mover of late. Well, the likes of the US dollar certainly has. Here we go. So there we go. So here is cable. So what's really interesting about cable on a weekly time frame is that this looks like it's topped out essentially. So we're seeing a breakdown through this neckline. Let's just get that horizontal neckline on. We've got these two lows, 131.4, essentially 1314. Yeah. Sometimes when I say these numbers, they sound weird. Okay, so yeah, we're breaking through this neckline. It points towards a double top formation. Of course, you've got the wider context, which is this sort of this big trend that's kind of like that. And then you've got, you could say that there's a wedge, but it doesn't really make it that much of a difference considering where we are at the moment within that, right? So you're essentially pointing towards a potential top coming into play here. If we see a sort of dovish shift from the likes of the Bank of England, then that could point towards a significant move towards the downside. The US dollar has been regaining ground of late, and certainly, part of the sort of US dollar story has been the delay in terms of easing from the Federal Reserve, but it's also been this US exceptionalism story and the breakdown in terms of trade relations. So I think that US-China trade deal does provide the basis for people to feel a bit more optimistic around the US dollar. And so the dollar index has certainly been gaining a bit of ground as a result. So keep a close eye for this neckline, because it's either an area where you can rebound from or an area where you can continue towards the downside. And if you were to enact a measured move, it would come from the neckline up to the head. So you're talking about 585, 0.585. So that points towards a potential move below 1.26. Of course, you potentially got trendline support coming into play there, but arguably I would ignore the trend line and probably care more about the fibs and start to see where those fib levels are. So 585 would mean a sort of deep retracement back down towards the 76.4 fib. There's plenty of space towards the downside, that's for sure. And if we look over the near term, how's this playing out? So what you're going to see is your sort of intraday trends, which will probably be highlighted in the hourly. There you go. So that's where you're getting your nice intraday trends. And that's very clearly trending towards the downside. And then you'll get, say, the 4-hour trends here. So we've got these sort of wider moves. So when you break out from that intraday hourly trend, so there's your hourly trend in there. Once you break up through that swing high, then you're retracing that wider move. So then you'll draw your fib from that. You come in, that looks like a 76.4 fib. Let's just see it just to entertain myself. There you go, 76.4, lovely. And then you start to drop back into your hourly trend once again. Well, we're in that hourly trend at the moment, and so just keep an eye out for this. If we break up through your first swing high, which might be different to this depending on how this chart moves between when I record this and when you're looking at it. If we break through the 1321 mark, then you're looking for a potential move into the 4-hour retracement, and therefore you'll be looking at that wider move. Of course, I don't know where the swing low is, so you draw your own fib. But yeah, at the moment, we're trying to challenge that neckline. If we break it, that's going to be a really interesting one to point towards further downside to come. And with inflation coming in weak at the moment, there's question marks around UK growth. If we see a particularly depressing UK budget that really puts pressure on the UK economy, then it all sort of points towards potential weakness to come for the pound as a result. And then finally, let's look at the... Oh, that's not how we want to look at it. There we go. Let's look at Australia. Now, the Australian rate decision that comes this week is a really interesting one because it comes hot off the heel of an inflation gauge that came in much hotter than markets had anticipated. And all of a sudden there, we've gone from talks of a rate cut to a potential rate hike. So that's why I thought this was going to be an interesting one to pull up. I mean, you've got a raft of other, I wouldn't say notable, but you've got a raft of other releases over the course of the week. You've got an inflation gauge on Monday, building permits, household spending, commodity prices, PMIs, imports, exports. You've got a lot going on. I think another part to be sort of following, and the commodities prices piece sort of highlights this, is that, of course, Australia is a major commodity exporter. And the US-China trade deal does provide the basis for greater growth. I'm aware of the fact that the latest Chinese manufacturing PMI came in weak at 49. But we do have the basis for potential strength in China, I think. If we see greater stimulus spending, if we see greater expansion into other regions, which is certainly something that's happened under over the course of this year, thanks to Donald Trump trying to break the relationship between the US and China. So I think the growth of China does provide the basis for potential strength in Australia and a potential strength for the Australian dollar. But, you know, maybe it takes a bit of time. But certainly I think if you're looking at the base metals space, keep an eye out for that, because a potential resurgence in that space points towards potential strength for Australia as a whole. As you can see here, wages and inflation relatively elevated. We've got sort of year-on-year wage growth, which is in orange. We've got these bars in grey, which is quarterly wage growth price index. And then you've got that year-on-year CPI figure, which tilted towards the upside in a meaningful manner at the last reading, and points towards inflation continuing to be a problem. Now, in terms of market expectations, you can see here, no change expected for November, no change expected for December. Then February, possibility of a cut. But like I said, in actual fact, if you look a little bit further out, 2026, you start to see calls for a potential hike. So there's question marks as to the direction of travel here for rates in Australia. That latest inflation reading certainly does cause concern. Now, generally within Australia and New Zealand, you see inflation coming out on a quarterly basis, something probably Donald Trump would love to see. Less data, please, and more vibes from Donald Trump. That's what he likes. Just tell you how it is rather than seeing the data. Nonetheless, that means that the latest inflation reading, we do get monthlies, but the more important is the quarterly. You know, it can take a bit of time before you see that next quarterly. 3 months, funnily enough. But for the time being, that means there's going to be significant question marks. So look out for this RBA meeting. Let's look out for the commentary to see exactly what they're saying in the wake of that inflation gauge. But certainly that provides the potential basis for Australian dollar strength. Now, I like to chart the Aussie against the Kiwi because, of course, they have fairly similar factors playing into it. So it's a good way of trying to sort of play the differentials when it comes to, say, interest rates and alike. So from a wider context, you can see, let's just go on to the monthly actually, you can see that it looks like we're sort of providing this massive basing pattern. Now you could say in actual fact, well, we're just in this massive consolidation phase. And you might be right. And certainly it's very notable that we've got the high here from 2015, the high here from 2022, and now we're coming back into it. That's 1.147. So we've got this massive resistance level up ahead. We're currently trying to exit this consolidation phase. You can see this sort of falling wedge, which is here when that gets in the way. This falling wedge, there we go. So we're exiting that wedge towards the upside. It points towards further upside to come. But there's a massive hurdle in the form of that big resistance level, 1.147. If we break through it, it provides the basis for us to really continue higher in a meaningful manner. But of course, that's a big if, because it is a massive historical level. We don't have much by way of resistance above it, though. So we either reverse from it, and the RBA meeting could do that, or we break through it and the RBA meeting can do that. And that's why this is a really interesting market to watch out for over the course of the coming week. Look out for whether we break through that level or whether we reverse from it. And certainly the tone around this RBA meeting will be really key for that. In the wake of that inflation gauge, do we see them point towards essentially them being done when it comes to easing thanks to inflation, and they're concerned on that front, or do we see them laying out a pathway that sees further rate cuts down the line? That's it for today. Make sure to like, subscribe and follow for more like this. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day and a great week ahead.